Hey guys, there's a ton of excellent benefits of owning real estate and lowering your income taxes. And we're going to be talking about that today with my CPA right here, Sandy. Hey guys, Brian Schroeder here with Faster Freedom. I have my accountant with me. She's a CPA with TA Ohms & Company. Her name is Sandy Ray. Sandy has been my personal and business accountant for like 15 years.
Long time.
We've been talking about a lot of stuff for a long time.
Yes, we have.
We have fun brainstorming together. Tax can be fun.
Oh yes, definitely.
You love it, don't you?
I do.
Most people hate, I don't know, even thinking about their taxes or brainstorming on anything, but it's like one of the largest expenses in most businesses.
That's true.
At least the successful businesses, right?
Right. They want to have taxes.
Right.
That means they're doing good.
Yes. We want to play the game so we know how to save as much as we can.
That's right.
You know I like to play the game.
Oh yes. Yes. we play it very well.
All right. There's a few things that I think about when I think about how does a real estate investor save money on their taxes. There's a few things that I think about. So I got a quick my top 6.
Okay.
My top 6 are depreciation, and we want to kind of get into it. Just think about a lot of the people on this watching this video might not really understand what depreciation is, so let's make sure we explain it.
Okay.
Capital gains tax versus ordinary income, 1031 exchange, tax-free exchange, some people call it. Not paying FICA tax on rental income. So a business owner has to pay FICA tax. We'll explain that, what it is. But somebody that you don't have to pay it on rental income.
That's right.
Tax-free borrowing. You can have an asset that you have equity in and borrow against it, and that's not taxable.
That's correct.
And the stepped up basis, so inheriting property on a stepped up basis. So those were the things that I was thinking about. And we can all add anything to it that I don't know if you got anything you want to add to that, but you do.
Yeah. Well, we'll look into a little bit further on each one of those items, and we'll see what else comes up.
That sounds good. So let's start with depreciation. I think that's the thing that most people think about when they think about how can I save on my taxes.
Yes.
Where do you want to do your disclaimer at?
Right here would be a good place.
All right.
Okay, so before we get started and talk about all the good things about real estate, let's talk about how this talk is designed to provide general information regarding real estate taxation, and it's not intended to serve as legal, tax, or other financial advice related to individual situations. So because each individual's legal, tax, and financial situation is different, specific advice should be tailored to the particular circumstances. So for this reason, you're advised to consult with your attorney, your CPA, or other advisor regarding your specific situation.
Perfect. I'm glad we got that out of the way.
That's right. That was a mouthful. So now we can go on to depreciation.
All right. So can you explain what depreciation is?
I can, yes. When you buy a property, you've got your building and you've got your land, and so the building portion of that can be written off or depreciated over time. So generally you're talking about 27.5 years for residential or 39 years for commercial property. So you take a portion every year that you own that and you write that off. You take a deduction for that, and that's called depreciation. So you just take a percentage of your costs and get to deduct that as you go along. So that helps you to have some tax write-offs, so you're not paying as much tax. You're reducing the amount of your rental income by depreciation.
So I'm going to try to clarify that just a little bit.
Okay.
You explained it very well. I'm not saying you didn't do that, but simplify it. So if somebody has a rental house that they bought, let's just say they purchased it for $100,000.
Okay.
A portion of that's going to be land. Let's just say maybe 10 grand.
10%.
Yeah.
$10,000 of the 100. Yes.
So that $90,000 in this particular case can be depreciated over 27.5 years.
Right.
So you just take 90,000 divided by 27.5, and I don't know what that is. Let's just say it's 3,000, maybe, sort of close.
Yes.
So somebody can, if they're income on their adjusted gross income on their tax return was 30,000, let's just say in this instance, they can reduce that by 3,000. So they're all of a sudden their income that they pay taxes on is only 27,000.
That's right. So they have $3,000 less of taxable income.
Yes.
So,
So let's just say they had 10 houses.
yes.
They have $30,000 income, but $30,000 depreciation, they can essentially not have any income, pay no taxes. That's possible.
That's possible, depending on other income and expenses that they have on that rental property.
Yes. So that's a power of depreciation. It's an expense that you're not having to pay anybody.
Right. It's a non-cash expense.
A non-cash
So it
expense.
doesn't come right out of their pocket, right?
Yes.
So that's a very good thing.
It is a beautiful thing. So now you want to go down to cap gains?
Sure.
So capital gains tax. So I don't know, there's so much about capital gains tax. There's some things that I really love about it and some things that I really hate about it. Love about it. So capital gains tax, you want to define it, what the definition is?
So the capital gains tax is the tax on the amount of capital gain that you have when you sell a property. So if you buy our property for $100,000 and we sell it for $120,000 a few years down the road, then we have a $20,000 capital gain.
Yes.
So that part is very good. And your capital gain rates are going to be 15%, or if you get a little bit higher income in like the mid 400s, and you're going to be paying like 20% capital gain. We do also have the 3.8 investment income tax. So for much higher taxpayers than, but for the most part, you're going to be paying 15%. And also, if you have very low taxable income, you could pay 0% on your capital gains. So that's something to look at. If you're below 78,000 on joint return, you could pay 0%. If you just had one property that you sold, had some capital gain, not a lot of other income, could be a really good deal. Most people are not aspiring to that part, but that can, something to look at, because if, timing is very important in real estate.
Your capital gains tax is based upon 0, 15, or 20, based on what your adjusted gross income is in that taxable year.
Or your taxable income is in that.
Taxable income,
yeah.
okay.
So you're going to look at your taxable income for that year.
Perfect. So just in general, simplifying it, typically your capital gains tax is going to be less than what your ordinary income tax rate is.
That's right. Normally it is, because it's going to be the lesser of the two. So, yeah.
So that's the benefit of capital gains tax. I hate to even bring this up, but what I hate about capital gains tax is I just feel like it's a tax on inflation.
You're probably right about that. It is. And the other thing to watch out for capital gains is you've got depreciation recapture. So that really good depreciation we just talked about before, where you're getting that write-off when you sell your property, that portion of the gain is going to come back in, and that's going to be taxed at a maximum 25%. So you get kind of capital gain rates, but a little bit higher.
Yeah.
So we just have to kind of watch for that and do some calculations so that you know what your tax is and what you're going to come home with after the sale of that property.
So just to clarify that a little bit more, so you are back to depreciation and capital gains. They kind of go together hand in hand. Mm-hmm. As you're depreciating the value of a property down, that's where your capital gains tax is based on. So if you've owned the house for 27 and a half years and you've got it depreciated down to 0, whatever you sell that for, if you sell it for $200,000, you're paying cap gains tax on $200,000.
That's right. And you'll have a blended rate on that capital gain income. You'll have 15% on the amount that was over the original cost. Then you'll have that maximum 25% on that depreciation recapture that we took over that 27 and a half years that we had it.
Awesome. I think we covered that pretty good, you think?
Okay, I think so.
On capital gains rates, so there's basically most people consider them long-term capital gains because you got to own it for a certain period of time.
You have to own it over a year.
So if you own a property for less than a year, ordinary income?
Right, it's going to be short-term capital gain, and that's taxed at ordinary income rates.
Yes.
Then you also have to look at the purpose of your investment. So if it's for investment, you're holding it long-term, then you get these long-term capital gain rates. But if your purpose is to flip a house and you're buying it and selling it within a few months, and your intent is not to hold it for long-term investment, then we're looking at, that's a whole different tax rate. That's your ordinary income rates, and it's also going to be self-employment income, depending on how you're structured, things like that. So that's a different thing than investment income that you're holding for rental property over a period of time.
Awesome. All right, let's move on. 1031 exchange. This is kind of relates a little bit to capital gains too. So,
it does, definitely.
So if you buy a house, well, you want to just explain what the 1031 exchange is?
Yes, I would like to do that. So what you're doing is you're selling your house, but you've already committed to, or you're going to commit to purchasing another house. So you're using those funds to buy another property. So you're really not trying to cash out of that original house, you're trying to reinvest those proceeds into another house. So you want to make sure you have a qualified intermediary that's holding the funds, that's very important. Then you also have the 45-day rule where when you sell your home, you want to make sure that you've named the property that you're purchasing within 45 days. So it's a pretty short time frame, you just have to make sure you go by those rules. Then the next thing is within 180 days of when you sell that original property, you want to purchase the new property.
You have to close on that new property.
You have to close on it, yes. So you've got those dates and you need to keep track. Pretty close
So
track
as
of
long
dates.
as you follow the rules, which there are some rules, you can sell one property and exchange into that next property without paying any tax.
That's right. You calculate your capital gain, but that capital gain is deferred. So that's an important part of this, is that it's deferred. It's not gone, but it'll just be deferred. The gain's deferred into the next property. The basis of the new property that you purchase is going to be lower by the amount of the capital gain that you deferred.
Yeah, and you know my goal with a lot of my properties is to own them until I die,
That's
which
right.
brings up to a stepped-up basis.
Let's go right into that, because that's the best scenario where you do the 1031 exchange, you've got low basis on your new property, then you hold that until you pass away, and your beneficiaries then take over the property. Well, they get that property and they step up their basis, called stepped up basis, to the fair market value at the time of your death. And then they keep that property, they start depreciating it all over again. They don't have that depreciation recapture, that's gone, and then they can keep the property and depreciate it and rent it out. Or if they sell it pretty close after the death of the person that they inherited from, then there's going to be no capital gains on that, because the fair market value at death is going to equal the sale price, and they'll have zero capital gain, and they just sell the property and keep the proceeds.
It's a beautiful thing.
It is very good.
And what's the inheritance tax these days limit? Where are we at roughly?
Let me see.
Just ballpark it.
Over $10 million.
Yeah. So as
we're-
long as you got an estate less than $10 million, your descendants, I guess, can inherit the property at what it's worth that day. You know.
Right.
So if I bought a house that's worth $100,000, over 27 years I depreciate it down to zero. By then it's maybe worth $300,000. Let's just say. My kids get to inherit that property, and the basis is $300,000. So they're starting from what the value of the property the day of my death.
That's right.
Good. That's a beautiful thing.
It is very good. Yes. Except for the passing away part, but
Yeah, it's all right. That's part of life. It makes me look at property differently these days, because I look at it from the perspective of I'm going to own it the rest of my life. It makes me very choosy on what houses that I want to own the rest of my life. Anyway. Side thing, I don't like paying capital gains on inflation, and that's what, if you own a house, if you buy it today for $100,000, in 30 years from now it's worth $300,000. That's just inflation. You didn't really earn anything. That house inflated because the government prints the money and all this other stuff. I'm getting off on a sidetrack. I should not do that. All right, let's talk about. You know what FICA tax is. FICA tax, you want to explain what FICA is?
FICA is the tax that you have when you have earned income, and you have FICA taxes on your wages, or you also have it on self-employment income. So then you're paying your Social Security and your Medicare tax on the amount of income that you make. So that's when you're doing like earned income type items.
So in the context of a business owner, which people that own rental properties, they're business owners, right?
Right.
So in the context of a business owner has to pay FICA or self-employment tax, which is roughly 15% of their earnings.
Right.
And what I love about rental property is you're a business owner, but you don't have to pay self-employment tax on your cash flow.
That's right.
That's the way I think about it. You know,
You're only paying the ordinary income rates on that.
ordinary income rates. So a business owner pays ordinary income rates, plus they pay self-employment tax.
That's right. So they're doing both types of taxes.
So if you have a plumbing business, you work your butt off all day long, you make a profit, you give, first of all, you give 15% of it to
Right.
FICA, government. And then on top of that, the government takes 20, 30, 40% of your income in ordinary income tax. The one thing that about rental property is you don't have that 15% FICA. You just have your ordinary income.
That's right. You're just paying it on the ordinary, just the income that you have, and you don't have to do, so you don't have self-employment tax that comes in there at that extra 15%, just the regular tax.
I think a lot of people don't realize how much they get taxed, but it's all out there. But rental property is a business. If you own rental property, you own a business, and you have that one benefit where you don't have to pay FICA tax.
Yes, that's right.
It's a good thing.
It's a very good thing. It's
better-
save you money, puts more money in your pocket at the end of the year.
That's right. Another thing that's really good is tax-free borrowing. So let's say you bought a house. Let's just say you bought a house 20 years ago and you got it paid down to nothing. So you bought a house for $200,000. Maybe it's appreciated to $300,000, but you've got it paid down to nothing. You can refinance that house, take out 80% of whatever it's worth, so $240,000 in this example. And on that $240,000, you can put it all in your pocket, and the government doesn't get any of it.
That's right.
Tax-free borrowing. Do you find a lot of your clients do that?
Oh, they do, yes. Because then they take the money that they borrow from that house and they invest in another house.
Yeah.
And then that way that gives them a lot more funds available to increase their business.
Yeah. I think that's one of the wonderful benefits of owning rental properties I've known some people that have paid a house off a couple times, over a 30-year period or something.
Right.
And then refinanced it, and they've gotten more money out of that house than their house was ever worth,
That's
because
right.
they've done it
They
a couple
keep
times.
turning it over.
And their tenant keeps paying off their mortgage, and they keep refinancing it back out.
Yeah, so the big thing is, you talked about your tenant paying, so you're looking for positive cash flow.
Yep.
So that's important when you're doing your rentals, and you want to make sure you also keep very good records. That's a big thing also. So you want to know exactly what your income is and what your expenses are, so that you can look and see, like, is this house worth keeping, or is this not working out for me so well? So you've got to know. You've got to be able to see the results of each of your houses as you go along.
Yeah, good stuff. There's one other thing that there's so many rules around tax, and as you know, but one of the rules that a couple of my friends have been tripped up with is on depreciation. There's income limits because a rich guy can't have all the benefits of an average guy, right?
That's exactly right. They put limits on. They put limits on there. Yes.
So what are the income limits for you to be able to actually take? So when we're depreciating, what we're doing is we're reducing our taxable income on our active income, on our other income that we're, if we're a doctor, let's just say we're a doctor and we make $500,000 a year, or maybe $1 million a year.
Right.
And you buy a bunch of rental property and you want to reduce your taxable expense by this depreciation, the government puts up roadblocks.
They do. So the roadblocks, and those are called passive loss rules and limitations that they have. So the real estate is passive income, so then they have the passive loss rules. So once your income gets above $150,000, and you're limited on the amount of passive losses that you can take. And so then those carry over. So then sometimes you might look at if you have gain on those, if you sell one, you have some gain, and that creates passive income, then you're able to take those passive losses that might have been limited and carried forward and
So
before.
depreciation is a passive loss,
Yes.
which if you're a high income earner, you can only take against passive income.
Right.
Which could be a capital gain or something like that.
Yes.
So there's one little loophole out there, and it's for what they consider, what's it called, a full-time realtor or something like
A real
that?
estate
A
professional.
real estate professional.
Yes.
How do you qualify to become a real estate professional?
Okay, well that you have to do a lot of real estate to be a real estate professional. You need to have more than 50% of your time that you're doing business has to be in the real estate business.
Okay.
So, and at the same time, at least 750 hours have to be real estate.
Okay.
So if you're working full time at a couple different things, then that, and then more than half of that's real estate, then probably you've got your 750 hours. And it's very important to document your time. If there's any question, I would think anyone that looks at Brian Schroeder and says, what does he do? He is a real estate professional.
Yes.
So there's no question about that because that's what you do all the time.
Yep.
But some people share that real estate business because it is such a good business and they can do their other occupation as well. So then you have to just show that you do more real estate than you do your other in order to be a real estate professional.
All right. How about if you're married and so in this case, the husband is the doctor and the wife is a real estate professional. Does that work?
That will work. Yeah, her property then, she's a real estate professional for that.
Because you're married, filing jointly, you just need one of you to be able to be a real estate professional
Right.
for it to work for the couple. Yeah. Yeah. So I think that's a fabulous way to figure out how can I take my passive losses against my ordinary income is if you can somehow fit in the box of being a real estate professional.
That's
But you
right.
got to follow the rules.
Yep, you gotta look at your rules.
Just got to
and make
figure
sure-
out how to
yeah.
play the game.
And you need to document.
Document.
Yes, that's right. So that way you have, you know.
In case you're ever audited,
That's right.
which happens.
Yes.
Yes. All right. I think I covered my top 6 benefits for owning a rental property. Did I miss anything? You had anything to add that you can think of?
See. Okay. I think just real estate is very good as a career by itself or also to supplement another career that you have.
Yeah.
There's, just looking at the rules and being able to, take a lot of the benefits that we've talked about can be very lucrative.
It can be very lucrative. Do you see a lot of your, I don't know, I'm not going to say better clients, but do you see a lot of your clients owning real estate and is it
I
helping
do.
them in their...
Yes, a lot of them, it is helping them. It gives them some diversity in their portfolio. And a lot of people have gone to real estate, they just trust real estate over time. And then when they look at, real estate that's going to give them positive cash flow, so it's not draining their other income as they go along, that, maybe depreciation is turning into a loss, but not the actual expenses that they're spending, then I think that can really help a lot. So yes, I see a lot of people that are doing, and then they just do the number of properties that they're comfortable with. So
Yeah.
some people have a higher comfort level than others as far as the number of properties that they're ready to handle. So usually they start small, and then if it
With a
works
single
for them,
family house usually?
yes.
Do you have any clients that own like big commercial buildings and so forth?
We do.
Yeah?
Yes. Mhm.
And that works well for them generally?
It does work very well for them. And a lot of people, they like to own the building that they have their business in.
Yeah.
So that's usually where they get started. And then if they like it, they might do that for somebody else and, find a building, and then they, can find a tenant for that building, and then it just builds from there.
Yep. So if if there's somebody new in the real estate business, or would they do to kind of, maybe they have never had a CPA before.
That could be.
How would they go about determining who's a good CPA for them, or that type of thing?
I think they would talk to, a lot of times they're going to talk to people who are in the industry already. So they're going to talk to other people. They probably have friends that have real estate. It might have been how they got into it. So they could talk to them, see who they use, and then talk about, what kind of services do they provide. And they might be really good at bookkeeping and they can do all that themselves. They might not be good at bookkeeping at all, and they need help with bookkeeping. They need to keep their records straight, and they need someone to help them from the very beginning all the way to getting the tax return filed. So I think the first thing is look and see what it is that you feel like you can do yourself, what do you need maybe some training on? And then, what's your ultimate goal? Do you want someone that can do a lot of that for you, or do you feel like you can do most of it and then they're just there to advise you as you go along to help make some decisions as you get into it?
Do you enjoy the aspect, and not only do you just enjoy it, but how do you go about helping people plan for their tax planning, or helping them maybe decide should they be buying rental property or adding to their rental property or whatever? Do you kind of work with your clients in that way?
We do. We like to look at, after we get taxes filed for the year, and then we look and see what can we do? Do we feel like we're paying too much tax, or there's some ways that we can kind of...
Does anybody feel like they're not paying too much tax?
No. Everyone would like to save tax.
Right.
But then not everyone is willing to do some of the things that it takes real estate wise to do that. So, people have to have a knack for it, and then, or they can have the desire to acquire the knack for it, and then they can go on with that. So then what we look at is, we look at their overall tax situation and see how could this help. And we want to just make sure that the type of rental property and just like the type of income that would generate, if that would be a good fit in their taxes. So I think the main thing is that they need to have a desire first, that's the type of investment that they want to have. And if
a desire for real estate.
A desire for real estate, yes. Because just to go out and do it, sometimes, because I've seen that and that doesn't work very well. So if they have a desire, then usually we can find some type of investment that's going to work and it makes sense tax-wise.
Yeah.
And then we look at their overall family situation, like we talked about before, for some future tax planning down the road, not just the next year.
No, I agree with you on the desire, because I've known a lot of people that have bought a couple, 3, 4, 5 rental houses and owned them for 2 or 3 years, and then found out it wasn't their thing and sold them, and they didn't really accomplish anything. As a matter of fact, there was like a headache more than a benefit.
Right.
You see that too?
I have seen that, yes. And then so then I think there's a lot to be said for them getting educated on the right type of real estate to purchase, and and then that's talking to their peers, other people who are in real estate, and learning from that as well.
Yeah. All right, guys, I hope you enjoyed this video. Sandy Ray with TA Ohms and Company and Associates, thanks for coming in and talking to us.
It was great to talk with you today, Brian.
All right.